Right, hello and welcome to Erik Penser Bank. My name is Jonas Thulin. I'm head of asset management, and I will try to briefly go through our house view as briefly as possible. It's only 88 pages, but I mean the basic executive summary is that we are maintaining our positions. We're overweight equities, we're overweight Europe. We see value, well, I shouldn't say value, but we see increasing interest in US growth, and we will position as such. Fortunately enough, 90% of our mandates are still beating the benchmarks, both short-term and long-term, which we're quite happy going through last year, which is obviously a down year on the portfolios as such, but also going into this year, which has obviously been flipping around everything. Now, the outlook for 2023 is pretty much the same. We still see a more normal market environment with growing equity markets and falling yields, and I will derive why. We still see increased blockification, but also the most important aspect on this is that the recession risk for Europe and Germany, which we questioned back in November when we started to massively buy into European equities, that suspicion that this might be overly bearish have made us to push down the recession risk for Europe to a 50% risk. Should probably be lower. We don't have a negative GDP growth for the year as such anymore. So we believe that a lot of this has obviously been priced in terms of the bearishness. So the risk reward is really for us to follow the data. And when we couldn't see the recession, we bought Europe. We don't care too much about the consensus. And so far, so good. The forecasts are as they are in terms of Eurozone. We still see a positive growth. We're a lot more positive on Swedish GDP growth than our local competitors. But we believe that people have been caught a bit too bearish up here in the Nordics and also in Europe. This is a long list of points that we derive. The key point for us here is that we make no changes to the outlook for 2023, and obviously we shouldn't because it's only January as such. But the longer the year rolls on and the more and more we write on these arguments or points, we can quite relax in terms of our allocations. The most important slide is this one where we still believe that we're going to move from high inflation to normal inflation, but we're going to maintain a low GDP growth. Hence, the equity market will move from roughly minus 10% to plus 15% on an annual basis from the 1970s. And we still see that shift happening, which is really positive, of course, and puts the whole world in a new context, I should say. So the inflation outlook is quite important, and do remember that 2022 was very interesting in the sense that yields and equities both delivered sharply negative returns and pretty much the same negative returns on a global basis. Now, the history, as it should be, or as it has been, is that when equity falls, you can pretty much push everything into the rate market, and you can actually make one-to-one in terms of gains and losses. So you benefit from a strategic allocation or diversification. That was completely upended last year. We believe that the historical pattern will re-emerge. Hence, we think that if you were to argue for still a weak year or a soft year, I think that's actually statistically more difficult to make that argument than come back to the trend that we've had since the 1920s, in the sense that yields will come lower and follow inflation, and equities will follow and climb in that environment, which we think is a bit more, it should be a bit more mainstream, but we do realize that it certainly wasn't back last year when we started to overweight equities back in going to Q4, and certainly not this year. We can timely calculate a 60-40 and a 40-60 portfolio with our indicator, which you can derive that we claim there should be overweight equities. We are overweight equities, and so far we're actually getting good rewards on that. The driving factors on the market are still that we think the macro uncertainty will come lower and financial uncertainty will come lower as well, as you can see on a 1-month, 3-month, and 12-month outlook. Now, a key question for us is to see that the uncertainties in media will fall compared to the uncertainties in the market. We are now roughly 3 times as stressed in media as we are in the markets, and that should obviously come lower. Now, I think it's pretty interesting to also come back to why this shift has been occurred in 2016, Trump Brexit. And it will be interesting to see if media can actually capture on a bit on the more macro and market news that are a bit more upbeat than the actual media is. If we break this down, it's not driven by Asian or American media, this is driven by European media. Now, this is a graph I showed you last time. Is put on here on PE numbers. We can show the discount that we saw in Europe, in emerging markets, in Germany. And this shift that when Europe really outclimbed and outmaneuvered the US in terms of the equity performance, and you have why the regressions that we ran on economic surprises, inflation surprises, financial conditions, and so forth. We never really derived why we made regressions on these variables. And the reason is that we can now, with this pretty complex graph, but we can decompose the daily yield and equity moves in various categories. Hence, we can see which categories are pushing the market lower in terms of 60-40 portfolio and which factors are pushing the portfolio higher. And then we can derive indicators for these variables. It's pretty straightforward, but it also, of course, depending on the IMF, ECB and Bank of England has done a proper job, which I think we can assume that they have in terms of deriving this. The magic number here is obviously the 14th of October when we saw the pivot in the market and this huge shift of downward pressure to the portfolios, to an upward pressure on portfolios. But it's pretty interesting to nerd down to the variables. And another way of looking at this is that we can conclude that financial conditions are macro. You can derive almost 90% on the daily moves in the equity market, both in magnitude and also the direction as such. As such, inflation is still of our concern. We have to forecast and track this. We put our foot down last March, claiming that this is the peak of priced inflation in terms of the rate markets. That has been locked solid, set in stone. As of June, we saw the peak in inflation. That's also set in stone. I think it's pretty interesting that people are still fretting about the inflation. I think we should fret about inflation, but not from an inflation point of view, but from a deflation point of view. All these factors are still speaking for lower inflation. In fact, it almost becomes arithmetically difficult not to end up in our 4 out of consensus view that US should reach sub 3%. Remember, this forecast was done in Q4 last year. It's pretty interesting now to see that you need to see monthly gains of 0.4 to 0.5% for inflation to not end up below 2.5% before year end. Obviously, this is a good reason for the fixed income market to price in cuts from the Fed. Things will unravel, potentially unravel quite quickly in terms of downside inflation. Supply bottlenecks peaked, as we all know, last year, more than a year ago, and we've been tracking it since. A bit concerning now in terms of the degree of fall here in terms of inflationary pressure from these. I should also throw in, what about China reopening? China is right now exporting deflation, so it's not really a concern that they're opening up, and that whole argument has a very difficult time to being substantiated in statistics. Now you can see here the pressure in inflation back in March, which is when the fixed income market put in their peak, and then you saw a headline rolling up until June and then rolling lower. There are very few indicators now showing an increasing pressure in inflation. And we don't buy in at all to the argument that core sticky excluding shelter should be a concern. It's rolling over as per normal. The wage growth should be a concern. It's rolling over as per normal. It's severely positively correlated to the headline inflation. So please do remember that wages are positively and following an unemployment rate and also the headline CPI, i.e. there is no such thing for the time being as a relationship between unemployment rate and inflation. I know there are some very well-known names out there arguing that unemployment rate has to go X amount of percentage for inflation to fall off. There really is no statistical relationship behind this, and IMF has made a great report on this as well. And you can actually see that the correlation right now between wage growth and unemployment rate is in fact very, very positive. So it's a bit of a bewildering argument to make for the time being, which is why the market keeps surprising a few people out there, I guess. It's also quite interesting to see that the one-year inflation outlook from consumers is actually sub 2%. And the outlook here is a bit more concerning. I'm not too concerned about inflation follow because we position for that. It's been our house view. I'm more concerned about the degree of 1 year inflation outlook. What if we break 1%? I think then we have to start to take deflation very seriously, and that could be a concern. So I'm more on that line of the scale than anything else. But before we even end up there, as you can all remember, we have inflation has to roll over, it can go down to 6% next month. And then it's going to keep on rolling over. And once it starts to coming into sort of sub 3% quite rapidly, we're going to be fully priced into in terms of cuts, etc., etc. I think that's a scenario that we are positioned for, and we're going to keep positioned for that as long as, at least in our view, data correspond to that. Peak hawkishness, that was some 4 or 5 months ago, so no concern there. That's still going to unravel. The Fed will obviously still hike and then cut. So we always knew they're going to end up with cutting rates in this hiking cycle. That's sort of been given from the very beginning. This is back before the first hikes over a year ago. Then we thought they're going to hike, but they're going to keep rates higher for longer, so to speak. And that's now been shifted to a much more rapidly shift upwards in yields, but also much more rapidly downshift in yields going forward. So this kind of blue boomerang is still concentrated. There's a small likelihood, about 10% probability, that the Fed won't hike in March. And I think that's pretty interesting. Even if it's only 10%, it becomes quite interesting for this week's Fed meeting to see, will they signal that they might end with these 25 basis points or not? Remember, it's only 10% probability that they would do that, but obviously that would be a huge market move for equities, and also be prepared on currencies in that perspective. The pivot was quite clear in October, and then we saw 75 basis points hikes going forward. But it's quite interesting now that we see such a strong consensus for 25 basis points, and if anything, 25 basis points going into the March meeting. But do remember that there's a small probability for actually no hikes in the March meeting at all. And the pivot here also was, of course, October 13th last year. So this shift going to more dovish, we think that's going to be maintained, pushing equities higher, yields lower. We don't see an issue with QT. I have some text here to explain the different curves. But what we're afraid of course, is that the financial system all of a sudden ends up without liquidity. We can't see that as of yet. We keep track on this every single day. And as long as we can't see it, QT is no problem. And we probably think they're going to slow down the speed of QT and to anticipate any concerns. Now yields will move lower, which is quite normal in this environment with falling inflation. I don't think this is so much to do with falling cyclical environment. Obviously, we're still looking into a soft landing, but it's not that we're concerned about the recession that keeps the yields moving lower. It's the massive fall in inflation and the soft landing. But we don't view this as a sign of a recessionary pressure or anything like that. Financial conditions rolling over as we've been arguing, and we're getting good traction. In terms of equities, I have a bunch of slides here showing that yes, you should be strategically overweight equities. Yes, the positive trading days are coming back to the market. You have abundance of liquidity being pushed out in China. High frequency models are turning upwards in China, so you should have some extent to Chinese positions, which we do have for the time being. We also look at the daily range indicator moving on the upside. You can see margin depth momentum moving on the upside. You can see risk indicators built on rate spreads, CDSs or vols being massively positive, which is a great indicator for our equity outlook. And you can look at highs, lows, advanced declines, bullish, bearish, and you can see a massive upside potential. And the whole thing just keeps on going like this. So I would argue to be bearish or be neutral or be underweight equities, it's a lot more difficult to derive in data than to be bullish and overweight equities. If you look at counterparty risk, dollar liquidity, vol curves, yes, massive upside as well. If you look at smart money index, yes, you see an upside there as well. So it just keeps on going like this. Flows, upside, shifts from cash to equities. Yes, you can see that people are shifting down their cash positions going into equities. That's following the drawdown in the market. No news there. You can actually see now the retail sentiment is catching up to the investor sentiment. The blue line here is peaking and rolling lower, which is quite interesting. The option market that really threw a wrench into the wheel of a Santa Claus rally, which is massive position that we saw in front of that option expiry, has of course disappeared and are now constructive and positive for the equity outlook. And also do remember that the bigger theorems like Tobin's Q, the replacement of capital, is showing no signs of an equity sell-off and hasn't for the last year. So this is sort of, in that perspective, an unwarranted equity sell-off. And we've had those a few times around. This is the fifth time. And we can see that we are now lagging in terms of the rebound from that kind of sell-off without replacement cost of capital being a leading indicator. So it will be quite interesting to see the continuation of that rebound, which we then believe will happen this year. So far, so good. The PE number, the Fed valuation, if you put it into a business cycle and adjust for the current yield, yes, buying. If you look at the whole view, but yes, people are much more nervous about missing the equity rally than they are about catching and avoiding the equity sell-off. So that's obviously constructive. If you look at earnings revisions, we still believe that we have troughed those. If you look at the global macro environment, they're doing the same thing. If you look at the daily or the price target revisions, you can see clearly these kind of rebounds coinciding with rebounds in the equity market. And we believe that we're going to have the same this time as well. So for us to be wrong, we have to adjust our cyclical outlook in the US quite aggressively. And when we combine the economic surprises with price target revisions and earnings revisions, we can actually see a continuation of the upside. So this is obviously driven by the economic surprise index. So everything fits quite well into our outlook for 2023 and how we position, how we prepared for this year, going back going all the way back to the trough in our equity portfolios, which was back in June. And it started to accelerate really going into the year end last year. And obviously this year has been a tremendous start for us. So we humbly follow the data as long as they point in this direction, but we really we have very little doubts in our minds for the time being. Now, a quick word on profits, because I think people are getting this whole discussion a bit wrong in terms of, yes, profits on an absolute level are weak in this quarter, but we knew that, and that's what we priced already. So what we now have to do is to price the future in the equity market. So if you look at 12-month so-called forward EPSs, you're actually 6 months behind the equity market. If you look at other indicators, you can actually see that even from an equity profit perspective, you should be long equities. We can see it in national accounting data, we can see it in various forecasts, and we think that's really encouraging as well. And also do remember that this year we're entering 2023 with a burst of credit expansion in the global economic cycle compared to 2022, where we saw the opposite. On top of that, we had a war, of course. We still do have a war. Now we have been quite fortunate in our forecast in terms of ISM and GDP, so we're sticking to our guns in this type of soft landing. If we were to fall in these rankings, i.e. we become worse in forecasting ISM and GDP, we will take note and really start to work harder on the macro side. But as long as we can sort of sail the waves and be quite accurate in our forecast, we have few doubts in our minds that we're going to end up in a soft landing in the US. We have a low recession risk in the US, i.e. below 25%. We have a soft landing still in our cards. You can see a heightened recession risk, but no red alerts in that sense. And what's really interesting now, if you want to nerd down a bit, is that you can actually see at the end of last week that equity sectors that should be doing well when GDP is expanding compared to doing well when GDP is slowing down, it's sort of made a little jump here. And we think that's pretty interesting and could cause us to make some adjustments in terms of the actual equity investments we have. But obviously it coincides with that. We can start to see the sort of soft landing and trough and then the rebound in the US. This would be quite interesting to see if we can tilt the portfolio in that direction. And if we were to do that, we're probably going to do it within a week or 2 weeks' time in order to be ahead of the game here a bit. Again, the Fed's recession risk is quite low, it's 22%, so it's nothing new there. In terms of global macro indicators, they're all troughing and they have troughed. And I think that's really is the contrast to where people were afraid Europe was going to end up. With the entire world troughing, it's pretty difficult for Europe not to start to get some kind of sound basing. On top of that, And you can break it down to the Chinese reopening, or you can call it the good weather or whatever. But it's very hard to find negative facts, at least. So that's something quite interesting for this very downbeat consensus view that's out there. Now, this also can be seen in plain daylight in terms of the GDP indicator in Germany and United States that are increasing on the upside, so that's quite interesting. And if you look at SAM rule, there's no recession risks, and if you look at the variables that define recession risk in the US, it keeps on climbing. If you look at the week ahead, we have a massive macro week. We believe ISM will come in at 48.5, we're higher than the consensus. Fed will do their hike of 25. When we have non-farm payrolls consensus, we're actually lower than consensus on the headline. But we also see hourly earnings a bit lower than everybody else. And then we have the ECB with 0.5, and also macro GDP numbers from Eurozone, which were higher than consensus and also higher in Germany. So the non-farm payrolls, we don't give too much credibility to our own indicator for this, because given the pandemic, we still have some time to work through the math on that one. But I think it's important to remember that the layoffs in US is happening in technology and finance. It's not in the big bulk side of the economy. And this happens because the equity market plummeted. The technology jobs are pretty easy to forecast by looking at the equity market. This probably means that as soon as the equity market shifts its direction, the job market will turn around. And also these people being laid off in tech and finance, they have an increased capability of just falling into other segments, i.e. pushing a lower pressure on wages as well. So we're not too concerned about these numbers. I think the market has become quite acutely aware of this. So 175,000 number probably won't scare the market too much, because you break it into the segments, the sectors, and everything to see if this trend that we see today is holding up into the next month. Interestingly, our hourly earnings peaked back in March, i.e. that's when the fixed income market peaked inflation pressure, so we believe it's going to come in lower again. Interestingly, job posting had made a bit of a jump, but that's quite positive, quite interesting. Unemployment rate should start climbing, but do remember that has nothing to do with inflation anymore, at least for the time being. But it will be a bit interesting to see what that will make with the correlation to inflation, because obviously that should break down if we saw that was to happen. But do remember that there are more jobs being created in the US if you look at JOLTS, given how many people are unemployed. So there are now more jobs, and they're increasing by 5 million more that are unemployed in the US, which is quite unique, quite interesting, obviously to a different salary level, etc., etc. But it's quite interesting to see how this will pan out in the US. ISM, we are a bit higher because we can start to see the trough in ISM, but really this shouldn't really be a big thing, because the equity market is leading ISM, the equity market has troughed. If you look at it on the level basis, ISM has to fall to below 40 to really validate the equity market sell-off that we saw, or the equity market was too bearish last year, which is sort of what I'm suspecting. But it will be a bit interesting to see how that will pan out when it comes in a bit stronger, which we have in our forecasts. We also have US Consumer Conference, the conference board, which is quite bullish if you compare to University of Michigan. Obviously, different questions in terms of focus on inflation, etc. But also interesting to see that we will actually be, that we're going to see a little bit of a trough in Swedish consumer confidence as well. Now, GDP data in Germany, we are above the consensus. GDP forecasts in Germany are all over the place, I would say. These are 3 leading institutes in Germany showing sharp recession, recession and a recovery, and then no recession. We have allocated on the top line of this, and the reason why is on this graph, that we can actually see daily macro data coming in still on the upside. There was a little bit of a scare going into late last year, but do remember that's when we actually bought the European equity market, and since then the recession probability has been becoming lower. The IFO clock has turned back, is working itself up to the boom segment again. So we were afraid, of course, obviously, for the downsizing and go into recession, but so far it's rebounding, and obviously being helped by, first of all, the bit more nervous, but October, November, the rebound in now costing data, which was sort of the start signal for us to reallocate to Europe. Now European GDP will come, but that will be a little bit of a lower focus, given that we already have France, Spain, and then Germany, of course, ahead of the number. ECB, do remember that compared to 1 month, 3 months ago, the rate curve has actually shifted lower. So we now have a lower rate curve than we had a couple of months ago. And we think that's also coincided with the rolling over inflation, et cetera, et cetera. So the market consensus is 50 basis points this week, and then another 50, and then that's probably pretty much it. And then you're going to start to look into a cut going into the late this year. It's pretty interesting to see that this is the consensus, so we're pretty maxed in terms of hawkishness. It will be a bit interesting to see, and obviously this week's they're going to do 50, they're gonna, like I was trying to speak hawkish because they are lagging in the US development, but it'll be pretty interesting to see when they make this shift, which the market is anticipating already by shifting down the curve. So it'll be quite interesting to see what will happen here in terms of, not so much this week perhaps, but going further out the year. Now the rebound in Germany and leading indicators is something that we've seen, and this is what we position, and I've been going on about these graphs for a couple of months now. We still believe that the OECD leading indicator will rebound in Germany. We can already see the pickup in the what I call a leading indicator for German equities, which is pretty much the production of chemical goods, etc., which is quite positive. Now, in terms of portfolios, we're still going on with our yearly forecast range that we're supposed to meet, even including obviously last year. So we're quite happy with that, and we're still ahead of the index for the time being, which is quite happy with as well. So the statistical overweight is working. And we're going to keep working and look a bit more opportunistic, perhaps going into US growth for the time being, which should look quite interesting actually. But that was it. We're back in 2 weeks' time with an updated house view. Their house view is maintained, as you can imagine, with the focus on Europe. And if anything, we will go to re-expand into different regions as we speak. But that said, I wish you all the best, and we have an interesting macro week, and we hope that we've been able to drive everything correctly, and we'll see how it pans out. So I wish you all a great week, and I will speak to you in 2 weeks again. Thank you.